So we get excited at Manage the Masses Towers when there is going to be a base rate decision, particularly when it's almost certain there is going to be a change in that decision. So the market had priced in that there was going to be a 0.25% Bank of England base rate cut. So what I want to do is just talk about what happened and more importantly what happened in the minutes of the meeting afterwards. So where we are now, the Bank of England base rate went from 4.25% to 4%. And that means for somebody who's got a tracker mortgage, for example, for every £100,000 that they borrowed over 25 years, then they're likely to see their monthly mortgage payments fall by £13 as a result of that 0.25% base rate cut. Now, if you're on a fixed rate mortgage deal, then you're not going to see any change at all if you're still in your fixed period. If you're somebody who's saving, I can guarantee that you're going to start getting emails in your inbox flooded with the banks and building societies out there cutting the savings rates that they offer you, unless, of course, you're in a fixed rate bond of some kind. And while I'm making this show, no doubt my own personal inbox is filling up with those rate cuts from various banks and building societies. That, unfortunately, is just the way it works. So with the rate cut, then you tend to get a slight delay when it comes to the changes you see in mortgage rates. Not when you've got a tracker, it's going to be fairly quick, but when you're looking at other things, maybe an SVR, but also the prospective rates in the market for new customers, then they tend to not react as quickly to cuts in the base rate as savings rate. So banks like to cut what they give away to people in terms of interest, but they're very slow when it comes to giving back or reducing the rates that they charge people on their mortgages. Now, having said all that, when it comes to prospective mortgage rates in the market, this rate cut was priced in. And so initially we might not see mortgage rates tumble or change at all because it was priced in. The rates you're getting on 2 years and 5-year fixes are taking into account the fact that there was going to be a base rate cut in August. So I wasn't expecting really any changes in the new rates you see out there if you're looking to perhaps remortgage, for example. But what I'm going to do is I'm going to show on screen the market predictions of where the base rate will be over the next 5 years. The chart on screen has a range of coloured lines. Each line represents the prediction or the predicted path of the Bank of England base rate over the next 5 years at the date that the prediction was made. So there's a blue line on the chart. The prediction was made on the 17th of September 2024, all the way through January, March, July, and then we've got an orange line, which is the current prediction, the 5th of August prediction. Now, what you can see is that if you go back to September last year, so almost a year ago, the Bank of England base rate was already predicted to be down towards 3% almost, and then would stay there over the next 5 years. Well, that's been torn up. The market predictions do change regularly. It does show you have to take some of these things with a slight pinch of salt, but by January, the market was predicting that the base rate wouldn't get below pretty much 4.25% over the next 5 years. We are now at the stage where the market is pricing in that rates will continue to fall, but slowly. So by January 2026, it predicts there will be another base rate cut from here. So we're going to go from 4% to 3.75%. Then by January 2027, the base rate will be down at 3.5%. Then the prediction is that it will stay there throughout the whole of 2027 and 2028. And then in 2029, it will start to creep back up again to 3.63% by the start of 2029. And then by January 2030, it will back up towards 3.8%. And then it will slowly creep towards 4% throughout 2030. So you can see that rates are predicted to come down slightly, but not significantly. Let's now focus on the meeting minutes from the latest rate setting meeting. So the Bank of England has a monetary policy committee called the MPC. It's a 9-person committee, and they sit down and at each meeting vote about what the Bank of England base rate will be going forward. So the change to the base rate. Will it stay the same? Will it go up or will it go down? And it's a majority vote. This time, 4 people voted for the base rate to be cut by 0.25%. 4 people voted to keep it as it was, no change, but one person wanted the base rate to be cut by 0.5%. So there was no unanimous decision. So they had to vote again at the meeting, and that is the first time in the MPC's history that they've had to do a second vote. So that shows you how close the decision was and how undecided the Bank of England was about what it would do with the base rate decision this time around. So they did a second vote, and the person who voted for 0.5% cut moved on to the team of people who wanted a cut of 0.25%. So we ended up with a 5-4 split. 5 people wanting the 0.25% cut and 4 people who wanted to keep the base rate the same. So we got the unanimous decision, and the decision was for the rate cut of 0.25% to end up at a 4% base rate. That actually shocked the market because the market was expecting a rate cut, but I think they were predicting that it would be more unanimous than it was. So you got this weird term that was used, a hawkish rate cut is the way some people within the media are describing it. So a hawkish anything is something where the monetary policy is normally tightened. So somebody who's a hawk likes to tighten monetary policy, or someone who's dovish is erring on the side of maybe cutting rates. So this was a hawkish cut, which seems a bit sort of paradoxical, but it was a cut that was not as clean as people were thinking. And that was because the Bank of England mentioned in those minutes that inflation is going to hit 4% later this year. So inflation has proved stickier in the last month or so than they previously thought it would. So inflation, rather than peaking at 3.7%, as they had thought it would do, they've now said it's going to go to 4%. And as you know, the base rate is moved to try and control inflation in the UK. So when inflation goes up aggressively, they tend to increase the base rate. If inflation is under control and back towards that 2% target, don't forget they're targeted to keep it within 1% of 2% as the target, but they will tend to bring them down if they've been elevated as they have been. So if we get a contracting environment, so we start to get maybe the economy doing poorly, then they will cut rates to try and support it. So we're in this strange scenario where the economy is looking like it's perhaps weakening, but inflation looks like it's picking up. And they're saying the pickup will be temporary, but of course, if it doesn't prove temporary, then they may have to stop cutting rates. So the market reacted, and you can see this reaction. If you ever get a Bank of England base rate decision, go and watch what the pound does against, say, for example, the US dollar. So in the aftermath of the decision today, the pound jumped about 0.5%, which is actually quite a big move on a daily basis against the US dollar. So it's strengthened, and that's because with currencies, it's a comparison. They don't operate on their own. It's always versus another one. So the fact that the Bank of England was deemed more hawkish than they previously thought, it then meant the pound rose against the US dollar. So we're at the scenario now where there was a silver lining for savers in a decision. So there's a rate cut. If you're a saver, you're thinking, well, my savings rates are going to start to fall. I'm going to earn less money on my money in the bank. But the silver lining was that the market is now thinking maybe rates will stay a little bit higher for a little bit longer. And we'll put a link to our best buy tables on the Money to Message website, but it'd be interesting to see what happens to fixed rates next week and mortgage rates more widely, and to see if the recent trend that we've had where they've started to creep down, because you can get a 2-year fix now at around about 3.8%. So that's the best 2-year fixes if you've got a 60% loan to value. Whether that creeps back up again or whether we just see things stagnate. If I had to bet on it, I think we're going to just see rates stagnate for a while until the market sees what happens with inflation in the autumn. And then I think in the coming months, they may decide that the Bank of England might have to cut rates. Oddly, ahead of this bank rate decision, there were some commentators in the market. Okay, they were isolated voices. They weren't the consensus, that were saying that the Bank of England would have to cut the base rate quicker than they are. And into 2026, they would have to cut by perhaps as much as another 1 percentage point. So that is all up in the air. People have different views, but the market consensus is still that we're going to get more cuts into the back end of this year. But we'll see what happens in the coming days, because that could potentially change.